On this on this panel, I've always enjoyed these because I think it allows us a little more. We're not talking models and legislation. We're talking more some emerging topics. We're talking with people who are kind of finger on the pulse of what's kind of going on in some of these areas. So we do have here a very esteemed panel with us today. Discuss some very important issues. And interesting topics, the need to accelerate and develop new products, get those to the market, and obviously the changing workforce that we have around us in this gig economy. And of course, we as legislators, we have to keep pace to repeal old, antiquated laws that need to be and need to be passed on and pass new ones that foster innovation, economic growth, while still protecting the consumer, which is our charter of all of us. The predicate of many insurance products, ranging from workers' comp to group products, is based upon an employee-employer relationship and model, and that has eroded in this so-called gig workers, increasingly based on a lot of app-based products. The gaps in coverage resulting from an erosion create strains on public safety nets, offer growth potential to numerous types of carriers to serve clients more completely. Given the accelerated pace of the gig economy, the typical development of insurance products arguably needs to be accelerated both by legislative and regulatory guidance and clarity. This session is a great opportunity to hear from those who have experienced in the constantly evolving gig economy and can provide some guidance as to what we as state legislators and our regulatory counterparts need to be aware of as we return home to our respective states. So, without further ado, joining us today on our panel is Dr. David Russell. David is a professor of insurance and finance and director of the Center of Risk and Insurance at California State University, Northridge. Ira Goldstein, executive director of the New York Black Car Fund. We've got Lamin Zarad, CEO of Joust Bank, and Curtis Scott, vice president and of global risk at Lyft. And I don't want to take up any more time, and they have a very extensive and very esteemed biographies that you will find in your little small handout books in the back, and take time to read those. So with that, just a couple of things we'll get into here. And if we can, we'll kind of take questions at the end, so make your notes from the panel here, and we'll hear from our experts now. So we'll start with this, and I'll kind of open this up for anyone for discussion. Your thoughts on the impact that will come now from the California Supreme Court's 2018 landmark decision, the Dynamex Operations West versus Superior Court of the gig economy. As you know, that decision and the subsequent legislation that codified that decision at its core makes it more difficult to classify independent contractors. The legislation has made headlines as being supported by organized labor and threatening the on-demand business models like Lyft or DoorDash. So right out of the gate to our panel, would you care to address that, and what do you see in that employer-employee relationship? So I'll open up to whoever wants to begin that and get your input.
Thank you, Representative Lehman. I'm David Russell. I teach insurance. I have for 27 years, and I appreciate the opportunity that the Griffith Insurance Education Foundation has given me to speak with you today. The gig economy is actually not a new one. Many of us have businesses of our own, side jobs, if you will. We multitask, and we may receive a 1099 at the end of the year, and we may file a Schedule C. Employees who work for an employer receive a different document, the W-2. I happen to receive both. So I'm a little familiar with being a contractor of my own. Many of you are as well. The reason we're talking about it today is it's more pronounced because of the ease with which the applications on our phones and technology has made it easier to seek short-term and on-demand provision of services and labor. You may recognize many of these logos. I've used them in the last 24 hours to get here. I'll talk more about that later. Some of these logos you may not be familiar with. Even since I drafted this presentation, I became aware that Uber has started an on-demand labor service in Chicago called Uber Works. So this is a rapidly changing landscape. So why are we talking about it now? And why is it so popular now? More and more workers are looking for a flexible lifestyle. And in fact, I took a informal and non-scientific poll on the way here with my Lyft drivers, asking them why they chose to be a Lyft driver. And the number one reason, both from them as well as surveys I'll share in a couple of minutes, is the flexibility and the lifestyle that it provides them. They can turn on and off work essentially on demand. Just as we demand their services when we need them, they can provide them when it suits their purposes. And as I mentioned, the technology that's available is continually evolving and makes it easier to source that work. Since the financial crisis of 2008, 2009, more employers are less willing to hire full-time and provide what might be described as an increasing full-time wage and benefits package. So the use of temporary workers is increasing. So it comes from both the employee side, the flexibility of that, as well as the employer side. They simply want to be able to surge their workforce and then rapidly downsize in the event that seasonal factors or economic factors lead to diminished demand. And finally, we see that more people need the money. High living costs, particularly housing, where I come from in California, it's really dramatic what it costs to even live with multiple roommates. And I teach a class, and I'm seeing in my papers that I'm getting here at the end of the semester the expression side hustle. So it's almost like students and the workforce of the future expects to have not only a full-time job, but a side hustle to supplement their income, not for luxury items, but for necessities. What are gig employees worried about? Well, as you would expect, being a gig employee, you don't get any benefits, and they're especially worried about health care. This is not so much the case for younger people, but it certainly is for people who are older than 30, let's say. There's also no job security. The unpredictable nature of a gig means that you're not quite sure how much demand or how much income you're going to receive from that gig will be. Also, when you operate as a contractor, you have expenses and training and capital costs and insurance, and we'll certainly talk about that shortly. And finally, we've seen efforts to organize labor. Uber drivers are trying to form unions, and they're essentially price takers. They can't impose on Uber a different price or wage structure, compensation structure. They merely take it or leave it. So that's one of the problems of a gig employee, is they don't have much bargaining power. So how many people are we talking about? According to a gig sourcing firm called Upwork, it's a publicly traded firm, approximately 57 million Americans freelanced in 2018, and that number's likely to rise in 2019 and 2020. And we're talking about approximately 1 billion hours of labor. This is a big number. The freelancers that Upwork reviewed, again, prioritize that work-life balance and flexibility over the amount of money they can make. And why do they need flexibility? They need it for personal circumstances. They may be in college, or they may be caring for a child during part of the day. They may be caring for an elderly parent part of the day. And they may have health issues or need to go to the doctor on a regular basis. All of these things lead them to prioritize the flexible lifestyle over money. And also, about 2/3 of those people found that work online. That's becoming easier and easier to do. I found this graphic in a McKinsey report that's a few years old, but this is a good way of looking at the sort of different categories of worker. Some workers do it by choice and some workers do it by necessity. McKinsey calls the free agents people that do it by choice, and it's their primary income. There are other people, like the Uber driver that took me to LAX yesterday morning. He actually is supplementing his income to send his daughter to college. I found that remarkable, that he was preemptively forming a college fund. His daughter's going to go to a school that's $50,000 a year, and that's a lot of driving he's going to have to do to put together that number. There are other people that are reluctantly contractors out of necessity. McKinsey calls those people reluctants. And finally, there are those that have to do it and they need the money. And McKinsey calls those people financially strapped. So people do it for many reasons, and it's not a one-size-fits-all type of model. As I mentioned, employers prefer this in many cases because it's cheaper for them and they can scale up and scale down their workforce on demand. Contractors, the two contractors I surveyed yesterday getting here, both wanted to remain contractors because of the freedom. The problem is they have few protections. And those protections as an employee might be, depending on the state you're in, a minimum wage, termination protections and notice of termination, overtime, paid breaks and rest periods, paid leave of all kinds, including parental and family leave, work-related injury protection such as workers' comp. We'll certainly talk about that later. And finally, as I've spoken about, health insurance or health coverage. All of these things are expensive for an employer, and therefore having contractors as opposed to employees is certainly the preference for many hiring firms. So what makes this particularly relevant today is last year was a case decided in the California Supreme Court referred to as Dynamex. And Dynamex was a delivery firm that prior to 2004 had employees who delivered things for Home Depot and other big box retailers. And after 2004, they decided they were going to reclassify their workers as contractors. And a former worker who worked there 3 months decided he didn't like this and felt that he was being misclassified, and this was in violation of some wage orders in the state of California. And he brought suit, and the class was certified, alleging wage and hour violations. Dynamex is a little complicated, but let me give you the short version. The drivers did own their own equipment and negotiated individually. That sounds very much like a contractor. They paid all of their own expenses. That sounds like a contractor. They set their own hours, although they provided a notification to Dynamex so that they could do scheduling. However, Dynamex did impose a number of requirements on them, including shirts and badges, control over their delivery activities and methodology, and they also had the right to terminate the contract very rapidly. So sort of a mixed message between contractor and employee. Ultimately, the California Supreme Court ruled for the class that, in fact, Dynamex workers were to be treated as employees and not contractors. And to set a precedent, they applied an ABC test that's used in some states. And the ABC test goes something like this. And I'm paraphrasing, and in the interest of time, I'm shortening this. Test A is that the worker is free from the control and direction of the hiring entity. Test B is that the worker performs work that is outside the usual course of the hiring entity's business. And C, worker is customarily engaged in an independently established trade, occupation, or business. And the problem for most firms that have contractors that do much, if not most, of their work is meeting that B test. The worker performs work that is outside the usual course. So if someone's loading materials for Home Depot onto the truck, and that's part of Home Depot's business, whether they're a contractor or not, the Dynamex case essentially says they're an employee. And the California Supreme Court, in making its ruling, had a few comments. And they believe that this ruling prevented business from evading their fundamental responsibilities to workers, and that this would stop a race to the bottom, resulting in lower wages and unhealthy conditions. I'm not here to take a position on whether or not this ruling is correct or not. I'm merely the messenger. But some estimates of this misclassification, if you will, amount to $7 billion a year in California's lost payroll taxes. And the estimates of how many workers in California will transition from contractor status to employee status ranges between 1 and 2 million workers. So the California Assembly and Senate, and finally Governor Newsom, have signed a bill, Assembly Bill 5, that have codified this. And effective January 1, 2020, the Dynamex ABC test will be applied to workers, formerly known as contractors, and this will give them protections such as minimum wage, paid leave, workers' compensation protection, unemployment insurance, et
Dr.
cetera.
Russell, if I can, just real quick, we started short on time, so if you can kind
Very
of
good.
wrap this up so we can get
So
thank you.
many professions were exempt from AB 5, especially those with higher paying and more negotiating power. So in short, AB 5 has not pleased everyone. The California Trucking Association is opposed to this. Governor Newsom is trying to broker a peace between labor and business, but both sides are somewhat polarized. And some of the leading apps, such as Uber, Lyft, and DoorDash, which delivers food, plan to spend $90 million on a ballot initiative so that the voters of California can overturn AB 5. Other states have decided to classify these workers as independent contractors for fear of being out of step with an evolving economy and creating uncompetitive labor costs. Spain and Canada have sort of a hybrid solution, and there are other hybrid solutions that are out there. You might call them a dependent contractor, where if it's a sufficiently large number of workers or a percentage of your time, then you would be classified as an employee. So why are we talking about this at NCOIL? Because there are a number of lines of insurance that are relevant in this particular debate. That's workers' comp, health insurance, unemployment insurance for those that drive or deliver. We're talking auto or general liability insurance, pensions and annuities that people that might otherwise not be able to save for themselves, employment practices that protect people against sexual harassment or discrimination. And finally, there are a lot of wage and hour claims that are brought against companies, and directors and officers liability insurance covers that, although a recent ruling called that into a question because SoCal Pizza, which owns some Pizza Huts, was not reimbursing drivers for expenses. So that is not a wage and hour claim, that's an expense reimbursement claim. So I'll turn the floor over to our industry speakers to give us their perspective.
Thank you. Who wants to go first?
Good afternoon. My name is Ira Goldstein. I'm the executive director of the Black Car Fund. Just to save time, we'll skip where I've been, credentials. What is the Black Car Fund? The Black Car Fund was formed back in 2000 in New York State when it was signed by Governor Pataki at the time. It was a direct response to inconsistent decisions at labor hearings as far as whether or not black car drivers were independent contractors or employees. The black car industry was pretty much given an ultimatum by the state government that they had to come up with a program to give the drivers workers' comp. It took a couple of years, but what they basically came up with is the model that I will be going into today. at a high level, the Black Car Fund, the requirements are fairly simple. It requires that all dispatch facilities, all bases that do 90% or more of their business on a non-cash basis, and that the fleet, the company that's doing the dispatching, owns less than half of their fleet, are required under the New York State law to become members of the Black Car Fund. The fund right now has grown to where we have, I think, closer to really almost 450 member bases, and we cover over 130,000 drivers in the state, and that's full-time and part-time drivers. We started with just pretty much New York State until June 2017, when New York State passed the appropriate bills to make the transportation network companies, the TNCs like Uber and Lyft, legal in the rest of the state, and that's when we picked up the rest of those members. And how does the fund work? It works. It's different than typical insurance policies. We're not working on a premium to the bases. We work on a surcharge. And what that means is that if you take a ride in New York State and it's performed by one of the black car, limo, or the TNC companies, there's a 2.5% surcharge that's tacked on to every trip that the bases collect, and they remit to the Black Car Fund on a monthly basis. The Black Car Fund was set up as a not-for-profit corporation, and the Black Car Fund board has the authority, and I'll be careful, I'm in a room with legislators here. We have a quasi-taxing authority, so to speak. The fund is allowed to raise or lower the surcharge on its own with just 30-day notice to the New York Secretary of State. And just some of the rationale behind that was that the majority of the board is from the black car industry, and they have a motivation to keep the surcharge as low as possible while fulfilling its statutory duties. The other thing is that we have member bases. The drivers themselves are not the members. So once a base becomes a member, if they dispatch a driver on a legal trip, whether the driver was licensed or not, he could have had a suspended license, whatever the circumstances may be. But if he was dispatched by the base, then that driver, that worker, has workers' compensation coverage. On the contrary, if New York, there's a lot of something, illegal street hails, they call it. Street hails in New York City are the right of the yellow taxis. So if a black car were to do an illegal street hail in the city, ultimately gets in an accident, then they would not have coverage under the law. Okay, over the years, the Black Car Fund has added some additional, I guess you would say, ancillary benefits that we've given to the drivers that are related to workers' compensation. In 2007, we started where we pay the drivers, if they come to us, they get $300 to complete a enhanced defensive driving class. In New York City, they're required to take that every 3 years. So they can take it every 3 years, get paid the $300. They could take it additional times if they need it just for the point reduction. We also, some years ago, we started a wellness program, which was interesting. The drivers can take this class and get paid $150. It's about a 3 to 4 hour class. We teach them about things like stretching and how to properly handle heavy luggage, other things that may be illnesses that are related to sitting in a car for long periods of time. They also learn how to respond to Amber Alerts. They also, through a grant with New York Presbyterian Hospital, they send a trainer in every week, and they learn hands-only CPR on the dummies. And also, Bike New York sends in a trainer every week, and they learn some additional safety lessons from, it's called Share the Road, with bicyclists and pedestrians, big issue in New York City.
And then, again, my apologies for the late start, but if we could wrap this up, we got a couple more things we want to touch on it for the panel.
Okay.
So go ahead.
This page has just some other additional benefits we've given over time, additional death benefit. They get a telemedicine benefit with their families as well. They get an optical benefit for an annual vision exam, plus they could get new glasses once a year, 6 months worth of contact lenses. And then we have a mental health and wellness program that we set up that was in response to, we had a rash of suicides in New York City, where 9 black car, livery, Uber, and taxi drivers killed themselves, and it was over their financial situations. So we set this up where we try to talk to them about keeping them from not only committing suicide, but giving them English as second language and how to run a small business classes to hopefully prevent that type of situation from happening again in the future. When the new phrase, as David said, the gig economy is not new, it just got a little bit bigger, and the word gig came around. We got much bigger when Uber came into existence, Uber and Lyft, and when they were mandated to be members of the Black Car Fund. That's when the fund has grown about 7 or 8-fold in the 9 years that I've been there. Okay, currently, after AB 5, there was a similar bill that was introduced in New York State. Then a senator and assemblyman in the legislature got together and put together a third way bill, something that was between the two. Last session, that got shot down. They reintroduced it again, this again with more benefits for the drivers. The unions made it clear that they were not interested in that, and that it now appears that there will be a bill that will be even more favorable to workers with employee status will be introduced in New York State. That, I guess you could say, would be harsher for employers, than California. And then any questions we could get into.
All right, thank you very much. We'll kind of stop there for a second. I want to move to a banking question, and then Mr. Scott will kind of wrap up with you, and then get to some maybe some closing remarks. One of the things I guess I would ask, and this is geared towards you, Mr. Zarat, as a banking CEO, the needs of this emerging employee, I should say, is different than what it would be a traditional. You have fluctuations of income, you have completely different work schedules, you have a lot of things that go into that. How are banks addressing some of the changes as well in these gig economies on this kind of employee-employer relationship?
Thank you, Representative Lehman. My name is Lamine Zarat. I'm a founder and CEO of Joust. And Joust identified and then addressed that exact same problem, the question that you brought up. It's the fact that the way people work is fundamentally different. And so new workers have fundamentally different profiles. And financial institutions are simply unable to grasp risks and the upside, the opportunities associated with these individuals. And so Joust was built as a neobank or a challenger bank specifically to address the needs of this new subsector of businesses. So we built it to address a predominant need that small businesses face today, and I use that term loosely. We don't like the word gig economy because it's not a monolith. It is in fact a quilt, and every independent contractor and every entrepreneur out there is very much part of the same movement. Folks are working in a very different way. They're empowered by technology to engage other people commercially across the globe. They're not bound by geography anymore, and it's fantastic. It opens up opportunities. It brings economic opportunities to, say, impoverished areas and so forth. But at the same time, it's a double-edged sword. It exposes these workers to, or rather, these workers are exposed to risks that they wouldn't be exposed before. The paradigm of a corporation is very much an industrial paradigm, where individuals, used to clock in and clock out to go to work and focus on what they do best. That paradigm doesn't hold anymore. The corporation is eroding. Corporations employ contractors, and then individuals engage in commercial activity independently. And so what happens, to put it bluntly, they don't get paid. And if you perform some sort of a task, a service, and you don't get paid, there's virtually no recourse. And that is what we're addressing at the core of our product. There are a number of groups that sort of comprise our customer base. We classify them as contractors, freelancers, and self-employed. They have a whole slew of needs, and however, we identified common needs. And those needs, access to capital, obviously, access to some sort of an insurance product to protect them against a whole slew of things that they face daily, and stabilization of cash flows. And this is a chart that actually shows what the gig economy looks like today, right? So I think when people think of the gig economy, they're automatically associated with the platforms like Lyft, Uber, DoorDash. It is not the gig economy. It's a tiny little sliver. U.S. represents 4% of the global independent sort of movement. And U.S. alone is about $4.3 trillion in transactions alone. It's an incredible sort of a tranche of the entire GDP. In any case, we also looked at a ton of research and kind of aggregated together, and this is what most experts predict, that by 2028, there are going to be 90 million people associated one way, shape, or form with this independent movement. And we won't get into the details, but obviously there'll be a huge divergence between full-timers, part-timers, hobbyists, and so forth. But there will be pretty much nearly the entirety of the workforce will have some degree of association with the gig economy. And so why reinvent banking, right? What's the differentiator that we bring that other financial institutions, for instance, don't have? It's that we identify the need, and the need is in de-risking the transaction itself. The need is not in placing your money somewhere where it's safe, right? This is almost a given. It's a commodity these days. You can store your money in Venmo, for instance. You really don't care about the FDIC insurance. But the need here is to sort of protect workers against non-payment. And we created a really unique product that combines a bank account, a merchant account to accept credit cards, and a tool we call PayArmor. And that is really the critical component of what we do. PayArmor allows our customers to generate an invoice and send that invoice and have two options when they send it in real time. Either guarantee it, so think of it as an insurance-like product. It's actually invoice financing for 1%, so it's incredibly economically accessible. Or for 6%, instantly fund that invoice, meaning that if they're going to get paid in 60 days, 90 days, whatever net terms are, those net terms are eroded to zero, and we give them access to that capital. And that addresses two of the primary needs that they have, either managing cash flows or accessing liquidity. And so we inadvertently stumbled into the entire new asset class. It was completely illiquid before. And those are receivables for quote-unquote gig economy. Our business model is also very unique. It's designed around sort of a micro business that's not flushed with capital. So we're not imposing fees like other financial institutions. In fact, our customers only pay for payments processing, but we generate revenues that we impose on our financial partners. Because we're not a chartered financial institution, we sit on top of a network of banks. We're able to capitalize on the fact that we bring in liquidity into the system, and those banks pay us, right? Our financial partners pay us. And we're able to sort of synthesize all of those different features that exist, make them highly scalable, and deliver them in one simple app to a gig worker. This is a team. We are quintessentially startup-y, as you can see, and we look and think like our customers, and we know their needs quite well. Despite our startup-y looks, we have probably over 100 years of experience in financial services. This is my second fintech startup. Prior to that, I was a federal bank regulator with the U.S. Treasury's Office of the Comptroller of the Currency. My co-founder was head of strategy at JP Chase, but we do think like our customers. And speaking of our customers, since launching earlier this year, we have customers now in every single state in Puerto Rico. And that just speaks to the need that exists out there to sort of have access to that type of financial product. Of course, we care about policies, and what we care about is aligning the sort of a legal framework that protects our users with our own interests. And we care about our customers getting paid, and we want to make sure that the federal government and state governments also care about that. There are a couple of municipalities today in the United States that have addressed some of the concerns that freelancers have. New York City, for instance, is one of them. I believe Minneapolis is the other municipality that enacted a law to identify the fact that freelancer work is not something that should be taken lightly by corporations and should be rewarded. And so we care about those type of initiatives, especially at the federal level. Of course, the tax law is outdated and doesn't account for this new way of working. And then banking regulations are incredibly outdated, and financial institutions simply have no idea what to do with a new worker. And so this is why there's joust. I'll keep it brief. Thank you.
Thank you very much. We'll finish the panel with Mr. Scott. And Mr. Scott, I think your fingerprints on about every, between Uber and Lyft and everything else insurance related. Would you like to chime in on this?
Sure. So just to start out, Curtis Scott, I'm with Lyft, formerly
You bring
with
the
Uber.
mic just a bit closer.
Sure. I'm an insurance nerd at the end of the day. I work on building insurance products that solve, a problem. I'm not a policy person, so I'll try to stay away from some of those thorny issues. But I think like NCOIL has been really set a standard in the TNC market that was very practical when we talked about auto insurance a few years back. And it set really a standard that said, hey, let's define a type of insurance. Let's define who it applies to. Let's define a limit that makes sense, right? It started out from that point, but then it created also this great flexibility where it said the rideshare company could provide it, the driver could provide it, a combination of them could provide it, and as a backstop, if it were to fail, the TNC would provide it again. And it really created a very interesting market dynamic in that it allowed the insurance industry, I think, time to react. We saw surplus lines insurers come in at first and provide coverage. We saw admitted companies come in over time, and now you have Allstate, Farmers, State Farm, Progressive, some of the biggest names actively underwriting this space. We've also seen individual products be sold by the likes of Geico, Allstate, and others. So selling endorsements that could extend onto a personal line policy, commercial policy specifically designed for it. But really, I commend NCOIL for creating an environment where the market had time to create solutions for the risk and give people options. And so I think that's really important as we look into next expansion areas. So when we think about, a lot of what's heard today is how do we deal with on the job accidents essentially. And there's different outcomes there. There's different options. And I think the Black Car Fund is certainly one that's worked for New York State for black car drivers. There's other models like workers' comp that's out there that I don't think was ever really intended for something that's truly this part-time in nature. And there are other private market products like occupation accident insurance that are sensible too. And I think we really need to thoughtfully engage and talk about these different solutions to figure out the right one. And I think, again, going back to NCOIL, is it set a standard. So we didn't create a standard that micro-dissected and took some people in, some people out, this type of worker, not that type of worker. And even in New York, we have a difference between black car drivers and taxi drivers. There's a livery fund, there's a black car fund. And so I think, a standard that makes sense, a standard that respects the flexibility that the participants in the gig economy want is important. And I think, as was called out here at a presentation, when you look at really the digital platforms, you're only talking about a small sliver of gig workers. So really, what are we trying to do at the end of the day? Are we trying to solve this for all these independents? Are we trying to solve it for one industry in particular? I think these are larger questions that haven't been answered yet. But I would say, again, in closing, I think it's important to remember the history that I think that NCOIL has already thought about in the past is that if you create a standard but also leave some flexibility for the market to respond to, we'll get a bounty of options, and I think that's the best for everyone. Thank you.
So if I may, kind of as we begin to wrap this up, kind of build on that a little bit, and I'd like comments from maybe all of you, is what do we do next? You're sitting here, you have it, you're in front of you, the legislative insurance thinkers of their respective states. What is missing? Is there something out there? We've talked about some of the work comp. You said how the Black Car Fund was created to kind of it's not an insurance company, it's not an insurance product, but what are we missing, and what's going to be on the horizon that we need to be aware of as we move forward in regulating this type of market? Because like I said when I opened, we are behind in a lot of things because of laws we put on the books. What needs to change?
Yeah, I'll take this first one. I think a fundamental understanding of the complexity of what the gig work is, and so many different signals in terms of the inputs, right, for a gig worker. If we can grasp all of the signals in a contextualized way and say, this is what this micro business really is, right, and these are its needs, and these are risks associated with doing this business, and then kind of build on top of that, and build policy really that's fundamentally modern in its approach, instead of kind of creating a Frankenstein of adding solutions on top of old and efficient solutions. Yeah.
Oh, I would just say that I think it's becoming clear that there's going to be a third way, what was referred to as a dependent contractor. I think with the direction that the workforce is going in, the two extremes aren't, one or the other isn't going to be the answer. And that there's going to be something like a dependent contractor, I think that most states are going to have to deal with. And it's just a matter of deciding how you want to, what you want to build into, giving in terms of rights and benefits to that third category is what's going to be important.
And if I can just piggyback on that, in California, the motivation behind AB 5 really was about lifting up the lower end of the workforce. There's a very large immigrant workforce in California, gardeners, Lyft and Uber drivers, migrant farm workers, et cetera. And I think AB 5 was an effort to loop in a lot of people that have been paid cash or been paid as 1099 contractors and trying to bring them into a fully employed status. Something I've noticed in the last couple of days, Senator Warren has proposed, because we have all this temporary hiring for the holidays, she's actually proposed a bill to extend many full-time protections to the holiday workers. So there, again, I'm not wading into political waters, but it's hard not to see an effort to raise what effectively is the minimum package of compensation across all categories, and the pushback from business about, well, this costs real money and someone has to pay this, whether it's a surcharge or an increase in the cost of goods and services, or finally the loss of some jobs.
All right, and then before I get to questions, and I'll get your Representative Kaiser, but you use the term dependent contractor. I think that's very interesting because you mentioned insurance nerd. I've been 30 years as a broker, and 30 years ago it was easy to determine between an employee and an independent contractor. Those lines are pretty clear. Those have become very blurred. And so now with this new potential kind of third entity of a dependent contractor, a lot of things are going to have to change. So I think that's an interesting concept. Representative Kaiser?
Mr. Chairman, and just interested in your perspective, although it's really not directly an insurance issue, it's a state issue. And that is, with this emerging gig economy and the movement to independent contractor status of some form or another, one of the problems the states have is with the traditional employee, we could garnish wages for child support. We are picking up the tab. When you all say how great this economy is, I ask you just to factor in what the states are paying for Medicaid and other forms of support for those employees. And we have no way currently of accessing those dollars. So it's coming. We will find a solution, but you should be prepared because it will have a significant impact on your economy.
Thank you. Senator Cooley?
Just a general observation about how we got this AB 5 and more to get sort of the big picture on everyone's radar screens. This was a court decision on the classification of worker, but they went to the so-called ABC test for who under California law is an independent contractor, which is going to be generally consistent, which was generally consistent with most American jurisdictions, and set it aside in favor of a new 3 AB ABC type of test. And the net effect of this change by the Supreme Court, although factually it was extremely limited, was to raise questions about all manner of workers out there and whether they were in fact independent contractors, including, for example, insurance agents. The bill was strongly supported by labor in California, and from even before the bill introduction deadline, it was widely understood that labor was looking to have only one bill on this court decision in California this past year, and that would be a decision to codify the Dynamex decision and apply it across the board. And it was just very apparent that they wanted only one bill. Eventually, as passed, there was a series of exemptions to the codification. And I think we're going to continue to have conversations about the proper scope of this and should there be further exemptions. But it's very much a labor move, and I'm a Democrat, to rewrite these rules, and it has broad implications on court reporters and guys who specialize in cutting down trees, so foresters can come in behind and haul the trees off, all kinds of categories of work. And the thing to know, if it ever comes up in your state, this bill was AB 5. I actually put in a contrary bill, AB 233. And if anyone's interested, they should look up the analysis, the first analysis, AB 233, online. It gives quite a recitation of the law in this area. But my approach to this issue was, because all of our states have a system of retaliatory taxation to kind of work out differences in the way states taxes get applied to various states, retaliatory taxation is frequently founded upon your state constitution as a scheme of taxation. And this actually means that in many states, as in California, the only use of the word agency in the state constitution concerns insurance agency. So with a lot of people wanting to codify the Dynamex decision, I took the approach that, well, fine, you can have that conversation, but here in California, our state constitution for 80 years has used the agency concept as a part of a tax scheme in insurance, so you should split off the insurance piece from this conversation. And when you look at AB 5, indeed, the insurance piece was the first cutout that was provided. But it's they were dealing with some very fundamental concepts, and the spillover to other areas of the economy becomes important. And I'm actually interested in the broad implications as well, but it became sort of an issue of how do you deal with the insurance ramifications of this bill, and we got ourselves an exemption with this constitutional argument.
Thank you, Simon. Any other questions, comments? Anybody in the committee? All right. Any comments from the closing remarks from the panel? I would like to thank the panel for your comments, and as if you don't have the app downloaded on your phone, all of their presentations are included on the app when you go to the sessions, and you'll pull that up. And so a lot of this information is great information. I appreciate that. Thank you again for being here. And we caught up a little bit of time, basically for those who missed the pretzel truck. I don't know if it's still out there or not. So if it's not, that's too bad. If it is, then you can grab one before our next session, which will start, hopefully get back on track, start promptly at 5:30. Again, I think what is next? I think it's our financial services, which has a pretty heavy agenda. So stick around for the next meeting, but you got a few minutes to relax, maybe see if the pretzel truck's still here.